A company announces it's splitting its stock 3-for-1, and suddenly everyone thinks the stock just got cheaper. It didn't. Here's the thing, a stock split is pure mathematics dressed up as magic. When a company does a 3-for-1 split, every share you own becomes 3 shares. Sounds like you just tripled your holdings, right? Except the company's total value, the actual thing you own a piece of, stays exactly the same. You didn't get richer. The pie didn't grow. Someone just cut it into smaller slices. Exhibit 1, the math. Say you own one share worth $300. The company does a 3-for-1 split. Now you own 3 shares worth $100 each. Your total, still $300. The company's market cap, the total value of all shares combined, hasn't budged. That's the mechanical reality. Nothing changed except the denominator. Exhibit 2, why companies do this anyway. A stock split doesn't change value, but it does change psychology. If a share costs $10, more retail investors can afford to buy one. Affordability breeds trading volume. More trading can mean more price discovery and liquidity. It's not about the math. It's about removing the friction that makes ordinary people hesitate. Exhibit 3, the historical pattern. Apple split its stock 5-for-1 in 2014. Tesla split 3-for-1 in 2020. In both cases, the split itself didn't create new value or guarantee price movement. But research shows that after splits, trading activity and retail participation often pick up. Whether that's correlation or causation is the open question. Here's what a split doesn't do. It doesn't make the company stronger. It doesn't increase earnings or cash flow. It doesn't change the business fundamentals. A company that's struggling before a split is still struggling after. The share price is lower, sure, but proportionally so is everything else. One more thing, reverse splits exist too. When a company does a reverse split, say, 1-for-10, 10 old shares become 1 new share. Same principle in reverse. The value doesn't change. The only thing that changes is perception. These are often used when stock price has fallen so low that it signals weakness or risks delisting. So when you see a stock split announced, understand what's really happening. The company is risklessing the pie to make individual pieces look smaller and more accessible. That's a legitimate strategy for boosting trading volume and retail interest. But it's not a gift. It's not a sign of strength. It's a mechanical adjustment that changes the appearance of price without changing the underlying value. Understanding how stock splits actually work and how they don't is the difference between reacting to headlines and seeing the mechanism underneath. Subscribe to keep unpacking the real mechanics of how financial systems operate, not the narratives built on top of them. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to keep unpacking the real mechanics of how financial systems operate, not the narratives built on top of them. This video is for educational and informational purposes only and is not financial advice. Always do your own research.